You can have the best trade idea in the world and still blow up your account. Want to know why? Because most traders treat position sizing like a suggestion instead of a survival tool. And that's exactly why 90% of retail traders fail within the first year. Look, I'm going to tell you something that nobody wants to hear. You're not going to make it in this game because of your chart patterns. You're not going to make it because you found some magic indicator. You're going to make it or you're going to fail, based entirely on how you manage risk. That's it. That's the game. Professional traders aren't smarter than you. They're not reading secret order flows you don't have access to. What they are doing is treating every single trade like one decision in a series of 10,000 decisions. And they structure their exposure so that being wrong doesn't end the game. Here's what I mean. Think about position sizing like a poker player thinks about bet sizing. If you go all in on every hand, you only need to be wrong once, one time, and you're done. You're out of the tournament. But if you bet a controlled percentage on each hand, you can be wrong 15 times in a row and still have enough chips to get back in the game when the odds shift in your favor. Trading is the exact same thing. The market doesn't care about your mortgage. It doesn't care that you really need this trade to work. It will take everything from you if you let it. And the way you let it is by risking too much on any single position. So what do the pros actually do? They work backwards. They don't ask how much they can make. They ask how much they're willing to lose first. They define their risk before they even think about their reward. And they tie that risk to their total capital in a way that makes it mathematically impossible to blow up from normal losses. This is where most people get it wrong. They see a setup and they think in terms of contracts or lots. How many futures contracts can I buy? How many lots should I open? Wrong question. The right question is, how much of my account am I putting at risk on this idea? Not how much am I putting in, how much am I risking? Because here's the reality. A 10% drawdown needs an 11% gain to recover. A 20% drawdown needs a 25% gain. A 50% drawdown, you need to double your account just to get back to break even. The math gets ugly fast, and that's why capital preservation isn't some boring side topic. It's the entire foundation of long-term profitability. You want to know the difference between someone who's been trading successfully for 10 years and someone who blew up in 6 months? It's not intelligence. It's not discipline in some vague motivational sense. It's a structured framework for sizing positions that removes emotion from the equation. When you have a real system, you never ask yourself how confident you feel. You never negotiate with yourself about whether this setup is worth a little extra size. You run the numbers, you know your max risk per trade, and you execute. No drama. No second guessing, no revenge trading after a loss because your position size was already calibrated to handle losses. The traders who survive long enough to actually get good are the ones who realize that protecting capital is more important than catching the next big move. They understand that you can miss 100 opportunities and be totally fine. But you can only make one catastrophic sizing mistake and you're finished. So if you're serious about this, if you actually want to still be trading in 5 years, instead of telling people you used to trade, you need to shift your entire mindset. Stop thinking like a gambler chasing the big score. Start thinking like a professional managing a series of calculated risks over thousands of trades. This is the foundation. This is what separates the pros from the noise. And if you want to see how the full framework actually works in practice, stay tuned. We're building something for traders who are ready to level up. Hit subscribe. More coming all week. Let's get it.